Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode, Buy a REIT, Real Estate Investing Without the Headaches.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam. And on today's podcast, our topic is Buy a REIT, Real Estate Investing Without the Headaches. Now, before you tune out and think REITs aren't real investing, or, hey, that's just for the Wall Street guys, stay with me. Because REITs, or real estate investment trusts, can play a role in an investment portfolio. By the end of the episode, you should know what a REIT is, why some investors buy them, the pros and cons, and if buying a REIT makes sense for you. So let's start off here with number one. So what is a real estate investment trust anyways, or what we call a REIT? This is going to be a very basic explanation if you haven't invested in them before, but a real estate investment trust is a company that owns and operates or finances income-producing real estate investments. So it's basically a business or corporation that compounds everybody's money and then finds income-producing real estate investments to invest the money in. It's much different than a syndicate. A syndicate focuses specifically on a single income-producing real estate investment. So a syndicate may get a group of 100 or 1,000 investors to invest in one commercial development or one complex or something like that. So they're a little bit different. With a REIT, instead of you purchasing a single-family residence or maybe even a multifamily or commercial building, you're buying into a company, and through the purchase of shares, that's how you become, or you get your ownership. The purchase of shares of the company that owns already a broad range of investment properties. So you're taking advantage and leveraging, just like if you were buying into Home Depot, Lowe's, or Boeing, or any of these things, you're buying into the company that is doing real estate investing on a large scale. Think about it like this. Buying a REIT is owning a slice of 1,000 properties instead of owning just one. And here's what can make a REIT attractive. By law, real estate investment trusts are required to pay out to investors at least 90% of their taxable income as dividends. You can find that in the Treasury Code and the Internal Revenue Code, and it talks about what the requirements are of people who are advertising real estate investment trusts or REITs. This means that investments may produce regular income because they're required to push money out. They can't come together as the board and decide, hey, they're not paying dividends this quarter. If there's income, then it has to be distributed. And since the income is passive, you don't have tenants calling you with issues after midnight, right? My toilet's plugged up, the lights aren't working, we've got some other issue, whatever it happens to be. You're not getting those calls late at night yourself. Your property manager's not getting those calls and texting you at 2 a.m. saying, hey, we got a flood we got to deal with. What do you want us to do? Any of those kind of things. All right, so secondly, or number two here, why do some investors like these real estate investment trusts? What would make a REIT attractive to most real estate investors? Now, I know most of the people who are watching this channel are investing in, flips, they're buy and hold, they're wholesaling, and they're passive in many of their buy and holds, whether it's short-term or long-term rentals, whether it's single-family residence or multifamily residence. But what would make a REIT attractive? I would say diversification, right? So it helps us to diversify our real estate investing portfolio. When REITs were created in the 1960s, the intention here was to give, or it did give, working class individuals or investors access to large-scale real estate investments. So for somebody who wants to get involved in investing, but in real estate, but really doesn't have the skills, doesn't have the knowledge, this created a safe harbor where they could invest in real estate because they saw the increase and they saw the appreciation, they saw all the benefits of it, and they wanted to be able to take advantage of that. Well, this gave an opportunity for just the common person, the person like you and I, just working every day, working hard to be able to invest into a broad base, a larger pool of real estate. Before this, owning larger commercial real estate was mostly reserved for, institutions, pension funds, ultra high net worth individuals. I mean, if you didn't have millions of dollars in reserve cash, it was hard to get into large scale or just scaling, these type of investments. But investments trust changed the way the game is played. Now, anyone can be a real estate investor with a small sum of cash. And this gives some other likable attributes to it, right? Number one, it creates liquidity. You can buy and sell shares in a REIT at will. You can, if it's like, hey, I've got this extra pool of money, I want to invest into real estate, and you do it now, and then you have an emergency come up in 9 months, and you need to liquidate that money, you can sell it at whatever par is at the time, whatever the stock value is at the time you sell your shares, you get your money, and then you can handle it. Where many of you know that if we're sitting on a flip, or if you have a rental property, sometimes those are hard to liquidate. First off, you got to find a buyer for the property. You may have to complete the property. You may have to do repairs to get the property ready, depending on what the tenant damage is on the property, all those kind of things. With a REIT, you have liquidity. And second, you have diversification. You can own hundreds of properties inside one investment. And you don't have to go out and find each one of them. You don't have to evaluate each property. You don't have to do any of that. When you buy it, the REIT, you're buying what the company has already evaluated and purchased. The third thing is you get passive income. You're not having to be in the office. You're not having to go inspect the property. You're not having to deal with your property manager. You're not having to acquire, components to repair the property. You're not having to go out source lumber and source labor, any of those kind of things. It's passive. While you're sleeping at night, it's producing income. And number 4 is transparency. REITs report earnings because they're regulated. They have to report what their earnings are and what their distributions are. But be aware, not all REITs are created equal. Not every one of them is the same. Here's a basic breakdown of the main categories of REIT. First off, there's 3 main categories. The first one is what we call an equity REIT. These are the most common. These are the ones that most people are talking about. If you're hearing advertisement for investment in a project being built on the coast of Mexico and Baja California or whatever, and these are the most common. You're buying equity into these because equity REITs own physical properties. They're building, large rental complexes. They're have bought industrial complexes or commercial space. And so they own physical properties. They collect rents. They make money from operations, and they make money from appreciation. So as the market continues to move up, because there's always going to be inflation in our market, it's the way things work. Things progress. There's always higher wages. There's always higher cost of goods. There's always going to be inflation. Inflation creates appreciation, and appreciation becomes profits. So this would include things like apartment, retail space, industrial warehouse, those type of things, those kind of REITs. So, and some of them have a combination of all of them. There's some REITs that only invest specifically in certain verticals. So when you're doing your research, you can determine whether or not you want to be in one or another that's with regards to what they're investing in. And really when you talk about REITs, this is really what most people think of when you're talking to them about a real estate investment trust. Second are what's called mortgage REITs. They're also called MREITs. They are just like they say, mortgage REITs don't own properties. They lend money, but they lend money into the real estate economy. They buy mortgage-backed securities, earn interest from rate spreads. And so they're basically buying the assets that the banks are out lending on, whether it's Fannie or Freddie or whether it's, mortgage bankers or brokers. They're buying this paper and they're getting the interest spread from the notes. They can have higher yields, but anytime you get something with higher yields, what do you also have? You have higher risks, right? It's the risk reward, balance or pendulum, that you have in that kind of scenario. They are also sensitive to interest rates. So they can be affected a little bit more by the interest rates that are in the market than a equity REIT. Okay, the third type of REIT is called a hybrid REIT. And just like the name indicates, it's a mix of both property ownership and mortgage investments. For those who are just getting started, equity REITs are usually the easiest place to start. There's more information about them. You can probably go to the library. You can go to YouTube. You can Google whatever. You can probably find more information about equity REITs than you could about a mixed or a mortgage-backed REIT or an MREIT. So that's something to consider. If you're just getting started, I recommend focusing on the easiest, most available. It may not necessarily have the spreads or the profits that you may get in some more risky REITs, but to get started, it's a safe harbor. And remember, as you learn more and you become more sophisticated at this, you can sell your stock in your current REIT and you can move it to maybe a more highly leveraged type REIT where there may be some more income. So let's look at some of the pros and cons. This is my third point here. Let's look at some of the pros and the cons, right? So, all right. So pro number one, the income is passive. You don't have tenants to deal with. You don't have leaky toilets. You have no rents to collect. You don't have to go knock on doors because people are past due. You don't have to worry about somebody meeting you at the door with a weapon saying, "What are you doing here to collect my rent? I'll pay when I want." Trust me, these are real scenarios. In the multifamily that my buddy George, he used to go collect rents in some unsavory neighborhoods, but he was a big guy. He was probably about 6'2", 6'3", and he looked like a bill collector. But there's some of those things. You don't have to do that with REITs. You collect dividends and move on with your life. Pro number two, instant diversification. With one REIT, you might own 200 apartment buildings across 30 states with thousands of tenants. By buying one investment, by investing money into the shares of a real estate investment trust. It's much more difficult to do something like that on your own. I'm not saying that you can't do it on your own. I have friends who have done it on their own, but they are few and far between where they have that kind of diversification. All right, pro number three, very low barrier to entry. You don't need a down payment. You don't have to get a mortgage. And you don't have to have great credit. You can invest with the cost of just a single share in an investment. And so it's much more easy to get into real estate investing through using a REIT. Number four would be liquidity. Unlike physical real estate assets, you don't wait months to sell. No buyer requirements for repairs. There's no inspections. There's no closing delays. When you buy it, you get it, and you're invested. Pro number five would be it's professionally managed. REITs are run by experienced executive and asset managers and leasing teams. So you have an experienced team that is running the asset, and it's not you. You get to piggyback on institutional level experience. In short, REITs make real estate easier, faster, and more accessible. But you know what? There is no perfect investment. So let's talk about some of the cons. Okay? Con number one, no direct control. So you lose control. You're giving somebody your money, and you're letting them do all of the work so you don't have control, which means you can't flip something into maybe an incredible thing that comes down the road if you got your money tied up. Now, you can liquidate it quick, but sometimes in my space, in the space we're investing in, you've got hours, not weeks, to get money on the table. You can't raise the rents. You can't renovate units to raise value. You can't refinance them, and you don't get to pull out the equity. So those are some of the cons. You're trusting the management makes good decisions, right? Con number two, market volatility. Public REITs are traded like stocks, so their value can go up and it can go down depending on the economy. That means the prices move daily. Emotion affects value. The short-term swing can be intense. Even if the properties are doing fine, a lot of times movements on stocks and like a REIT, is based upon emotion. Maybe some bad report comes out. Con number 3, tax considerations. REITs are dividends, and they're usually taxed as ordinary income, which is a big change from your own investments. You lose your depreciation, you lose your cost of goods investment. There's a lot of advantages to doing other type of real estate investing. So this is one of the cons, one of the drawbacks. Number 4 con, lower leverage. REITs use leverage, but not like individual investors, and they take advantage of leverage. You don't. So you're buying one for one when you invest in the real estate investment trust. So number 4, does buying into a REIT make sense? The answer is, it depends. Here's a quick comparison. Physical real estate that you have, well, you'll have more control, more leverage, potentially higher returns, but they're more work and they're more risk. With REITs, you get more passive, more liquid, easier diversification, lower stress, and potentially much, much lower returns. And that's why many investors invest in both. They continue to flip, they wholesale, they use these for active income, they use rentals for appreciation and tax benefits, and passive income. And then they use a REIT for liquidity and diversification. If you're ready to start investing into REITs, here are a few practical steps. First, do your homework. This isn't a bypass on doing the research needed before buying it. You got to do your homework. Just like you wouldn't buy your first apartment complex that you saw without running the numbers, REITs are the same. Compare investments before buying in. Don't just buy the first REIT that somebody happened to toss at you. Compare the rates of return, their historical performance, what they're invested in. Talk to your tax advisor. See if there may be some advantages investing through maybe a retirement account. This is investing. It's not gambling. So take your time. Hey, if you found value in today's episode, be sure to subscribe and leave us a review. And share this with another investor who needs to hear it. That's all for this episode. Thanks for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Be sure to check out our previous episodes of real estate-related investing topics. I'm glad you're part of our growing real estate community, and you can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.